Hello, and welcome to the beginning of a journey that can reshape your future. We're about to explore a topic that isn't always taught in school, but is fundamental to navigating adult life in the United States. That topic is financial literacy. Imagine for a moment that you've been given the keys to a high-performance car. You know it can take you amazing places, but no one ever taught you how to drive it. You don't know what the different pedals do, how to read the dashboard, or even what kind of fuel it needs. You'd probably feel a mix of excitement and anxiety. In many ways, our financial lives are just like that car. We live in one of the most complex and opportunity-rich economies in the world.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
But many of us are never formally taught how to manage the vehicle of our own personal finances. This series is designed to be your driver's manual. We won't tell you exactly where to go. That's your journey to decide. But we will teach you how to drive. We'll show you what the gauges mean, how to maintain the engine, and how to navigate the roads ahead with confidence. So let's start with the most basic question. What exactly is financial literacy? At its core, financial literacy is the knowledge and skill set to manage your financial resources effectively for a lifetime of financial well-being. It's not about being a Wall Street genius or knowing how to predict the stock market. It's about something far more practical and powerful. It's about having the confidence to make informed and effective decisions with your money. Think of it as having 5 core pillars. The first and most fundamental pillar is earning and budgeting. This is all about understanding your income, tracking where your money goes, and creating a plan, a budget, that aligns your spending with your personal goals. It's the starting point for everything. The second pillar is saving and investing. This is the art of paying yourself first. It's about setting aside money for future goals, whether that's for a down payment on a house, your retirement, or simply building an emergency fund. It also includes understanding how to make your money work for you through investing, leveraging concepts like compound growth over time. The third pillar is debt and credit. In the United States, credit is a major part of the financial system. Understanding how to use debt wisely, what your credit score means, and how to manage it is absolutely critical. It affects your ability to get a loan for a car, a mortgage for a home, and even the rates you'll pay for them. The fourth pillar is financial planning and goal setting. This is about looking at the big picture. It's the ability to set long-term financial goals, like retiring comfortably or funding a child's education, and creating a realistic roadmap to get there. It's about moving from simply reacting to your finances to proactively shaping your financial future. And the fifth pillar is risk management and protection. Life is unpredictable. This pillar is about protecting yourself and your assets from financial shocks. This includes understanding the role of different types of insurance, health, auto, life, and disability, and creating a safety net for when the unexpected happens. Now, why does this matter so much, especially right here in the US? The American financial landscape is unique. For generations past, many workers could rely on a pension from their employer for a secure retirement. Today, that system has largely been replaced by individual retirement accounts, like the 401k and the IRA. This is a massive shift. It means the responsibility for saving and investing for retirement now rests almost entirely on our own shoulders. Without financial literacy, navigating this responsibility is incredibly daunting. Furthermore, we live in a consumer-driven society. We are constantly surrounded by messages encouraging us to spend. Having a strong foundation in financial literacy helps you cut through that noise. It empowers you to make conscious spending decisions that serve your goals, rather than simply reacting to the latest trend or advertisement. It helps you distinguish between wants and needs, and gives you the framework to enjoy your money without jeopardizing your future. Financial literacy is also the key to unlocking true financial freedom. What does that mean? It means having options. It means not being trapped in a job you dislike because you're living paycheck to paycheck. It means having the resources to handle an unexpected medical bill or a sudden car repair without going into crisis mode. It's about reducing the stress and anxiety that so often come with money worries. When you understand your finances, you are in control. That control brings a sense of peace and security that is truly priceless. It's important to state clearly what this series is and what it isn't. This is an educational resource. We are here to provide you with knowledge, context, and a clear understanding of financial concepts. We are not providing financial, investment, legal, or tax advice. The goal is to empower you with information so that you can make your own informed decisions or have more productive conversations with qualified professionals. Our aim is to build your confidence and your competence. Over the next several chapters, we will dive deep into each of the pillars we've mentioned. We'll break down complex topics into simple, understandable language. We'll explore budgeting strategies that actually work, demystify the world of credit scores, explain the basic principles of investing, and so much more. Your financial journey is personal. Your goals, your income, and your circumstances are unique to you. But the principles of financial literacy are universal. They are the tools anyone can use to build a stronger, more secure financial life. Think of this first chapter as opening the toolbox. The tools are all here. In the chapters to come, we'll learn how to use each one of them. Thank you for taking this first crucial step. Welcome back. In our last chapter, we defined financial literacy and laid out the 5 core pillars that form the foundation of a strong financial life. We talked about how financial knowledge is your most important asset. Today, we're going to build directly on that foundation by tackling the first and most practical pillar: earning and budgeting. If you ask people what word comes to mind when they hear budget, many will say things like restriction, diet, or boring. For many, a budget feels like a financial straitjacket, designed to stop you from enjoying life. I want to challenge that idea. A good budget is not about restriction, it's about intention. It's about freedom. Think of it this way. If you were going to build your dream house, you wouldn't just start buying materials and nailing boards together randomly. You would start with a blueprint. That blueprint would tell you exactly where the walls go, where the windows will be, and how every room connects to create a functional, beautiful home. A budget is a blueprint for your financial life. It's a plan you create that directs your money where you want it to go, so you can build the life you truly want, one that is both enjoyable today and secure tomorrow. So, where do we begin? The first step in creating any plan is understanding your starting point. You need to know your numbers. This means getting a crystal clear picture of 2 things: what's coming in and what's going out. Let's start with what's coming in: your income. For many people, this seems simple. It's the number on their employment offer letter or their hourly wage. But the number that truly matters for budgeting is your net income, not your gross income. Your gross income is the total amount of money you earn before any deductions. Your net income, often called your take-home pay, is the amount of money that actually lands in your bank account after deductions like federal and state taxes, Social Security, Medicare, and perhaps contributions to a workplace retirement plan or health insurance premiums. Your net income is the real amount you have available to work with each month. Once you're clear on your net income, the next step is to understand where that money is going. This process of tracking your expenses is perhaps the most eye-opening part of budgeting. Many people are genuinely shocked to see how small, frequent purchases add up over the course of a month. How do you track your expenses? The method doesn't matter as much as the consistency. Some people prefer using a simple notebook and pen, writing down every purchase. Others might use a spreadsheet on their computer. And many today use banking apps or budgeting tools that can automatically categorize their spending. The goal for the first month is not to judge your spending or even to change it. The goal is simply to gather data. You are a detective, looking for clues about your own financial habits. After you've tracked your spending for a few weeks or a month, you can begin to organize it into categories. A common and effective way to do this is to separate your expenses into 2 main types: fixed expenses and variable expenses. Fixed expenses are the costs that are generally the same every single month. These are the predictable pillars of your budget. Think of things like your rent or mortgage payment, a car payment, student loan payments, and insurance premiums. You know they are coming, and you know the amount. Variable expenses, on the other hand, are the costs that change from month to month. This category includes things like groceries, gasoline for your car, utility bills that fluctuate, dining out, and entertainment. These are the areas where you often have more control and flexibility. With your income understood and your expenses tracked and categorized, you are now ready to create your blueprint, the budget itself. There are many different methods and philosophies for budgeting, and the right one is simply the one that works for you. Let's look at a few popular frameworks as educational examples. One widely known guideline is the 50/30/20 rule. This is a simple framework for allocating your take-home pay. The idea is to direct 50% of your net income toward your needs. These are your essential fixed and variable costs: your housing, transportation, utilities, and groceries. The next 30% is allocated to your wants. This is for the discretionary spending that makes life enjoyable, like hobbies, entertainment, dining out, and vacations. Finally, the remaining 20% is directed towards savings and debt repayment. This includes building an emergency fund, saving for retirement, or paying down high-interest debt beyond the minimum payments. It's a great starting point for seeing how your current spending aligns with a balanced approach. Another popular method is zero-based budgeting. This approach is more hands-on. With a zero-based budget, you assign a specific job to every single dollar of your income. Your income minus all of your planned expenses, savings, and debt payments should equal zero at the end of the month. This doesn't mean you have $0 left in your bank account. It means every dollar has been intentionally allocated. This method requires more detail, but gives you an incredible level of control and awareness over your finances. A third powerful concept is often called the pay yourself first method. The principle is simple. Before you pay any bills, before you buy groceries, before you spend on anything else, you direct a set amount of money from your paycheck directly into your savings or investment accounts. The most effective way to do this is to automate it. By setting up an automatic transfer from your checking to your savings account on payday, you treat your savings goal just like any other non-negotiable bill. This prioritizes your future self and builds your savings habit on autopilot. Regardless of the method you explore, remember that a budget is not a rigid document that you set in stone once. It's a living, breathing tool. Life changes. Your income might increase, or you might have a new expense. It's important to review your budget regularly, perhaps once a month, and make adjustments as needed. Be realistic and be kind to yourself. The goal is not perfection. The goal is progress and intention. By creating and using a budget, you transform money from a source of stress into a tool that serves you and your goals. You are no longer wondering where your money went. You are telling it where to go. You are in the driver's seat. In our next chapter, we will build on this foundation of control and take a clear-eyed look at another critical topic: understanding the world of debt and credit. Hello and welcome back. In our last chapter, we created a blueprint for our finances by exploring the world of budgeting. We learned that a budget isn't a restriction, but a tool for intentionally directing our money toward the life we want to build. Today, we're going to discuss a topic that is deeply integrated into the American financial system, and one that often carries a lot of emotional weight: debt. For many, the word debt sounds negative, like a problem to be avoided at all costs. But that's not the complete picture. It's more useful to think of debt as a powerful tool. Like any tool, it can be used to build wonderful things, but if mishandled, it can also cause significant damage. The key to using this tool effectively is knowledge. And closely tied to the concept of debt is its counterpart, credit. In the United States, credit is essentially a measure of financial trust. When a lender extends you credit, they are trusting that you will pay that money back over time. Your history of managing that trust is recorded, and it becomes a crucial part of your financial identity. To start, it's helpful to understand that not all debt is created equal. Financial educators often speak about the general concepts of good debt and bad debt. Good debt is a term often used to describe money borrowed to purchase something that has the potential to increase in value or increase your long-term earning potential. The most common example is a mortgage. You borrow money to buy a home, which is an asset that over the long term has historically tended to appreciate in value. Other examples might include a student loan to obtain a degree that can lead to a higher-paying career, or a business loan to start a company that can generate income. The idea is that this type of debt is an investment in your financial future. Bad debt, on the other hand, is a term typically used for money borrowed to pay for things that lose their value quickly and do not generate income. This often involves high-interest debt for consumable goods or experiences. The most common example is carrying a large balance on a high-interest credit card for non-essential purchases like expensive dinners, clothing, or vacations. The item's value is gone long before the debt is paid off, and the high interest rates can make the original purchase cost many times more in the long run. Understanding this distinction is the first step. The next is to understand the system that powers it all: your credit. When you borrow money and make payments, 3 major credit bureaus in the US, Experian, Equifax, and TransUnion, collect this information. They compile it into a credit report. The information in this report is then used by scoring models, the most well-known of which is the FICO score, to generate a 3-digit number. This is your credit score. Think of your credit score as a financial report card. It's a quick summary that lenders use to gauge your creditworthiness. This single number has a massive impact on your financial life. It can determine whether you get approved for a loan or a credit card, And most importantly, it influences the interest rate you will be offered. A higher credit score is often seen by lenders as indicating lower risk, which can result in a lower interest rate. Over the life of a major loan, like a 30-year mortgage, even a small difference in the interest rate can translate into tens of thousands of dollars in savings. So, what determines this all-important number? While the exact formulas are proprietary, the scoring models are transparent about the key factors they evaluate. There are 5 main components that make up your credit score. First and most important, at about 35% of the score's weight, is your payment history. This is a record of whether you have made your past debt payments on time. A consistent history of on-time payments is a strong positive indicator for lenders. The second most important factor, at about 30% of the weight, is amounts owed. This isn't just about how much debt you have, but more specifically, how much of your available credit you are using. This is often referred to as your credit utilization ratio, particularly with credit cards. It's calculated by dividing your credit card balance by your total credit limit. The third factor, weighing in at around 15%, is the length of your credit history. In general, a longer history of responsibly managing credit is viewed more favorably. This factor considers the age of your oldest account, your newest account, and the average age of all your accounts. The fourth factor is credit mix, which accounts for about 10% of your score. Lenders generally like to see that you can successfully manage different types of credit. The 2 primary types are installment debt and revolving debt. Installment debt involves a loan for a specific amount with fixed monthly payments for a set period, like a car loan or a mortgage. Revolving debt, like a credit card, gives you a line of credit that you can draw from and pay back as you wish, as long as you make the minimum payment. Finally, the fifth factor, also at about 10%, is new credit. This looks at how many new accounts you have recently opened and how many recent inquiries have been made into your credit history. Opening several new credit accounts in a short period of time can be seen by scoring models as a potential sign of increased risk. Understanding these 5 factors demystifies the credit score. It's not some arbitrary grade. It's a reflection of your habits and history as a borrower, based on these specific data points. By understanding how debt and credit work, you are no longer a passive participant in the system. You are an informed navigator. You can see how your actions today, like the decision to make a payment on time, or how you use your available credit, directly shape your financial opportunities for the future. Now that we have a budget in place and a clear understanding of the credit system, we are ready to move from managing our obligations to actively building for the future. In our next chapter, we will explore the powerful engine of wealth creation, the world of saving and investing. Hello, and welcome back to our journey toward financial literacy. In our first few chapters, we've been building a strong financial defense. We created a budget to take control of our cash flow, and we demystified the world of debt and credit to help us navigate the system wisely. Now it's time to shift from defense to offense. It's time to talk about how to make your money start working for you. Today we explore 2 of the most powerful and hopeful topics in personal finance: saving and investing. While people often use these terms interchangeably, they are 2 different things, each with a distinct and important purpose. Saving is the process of setting aside money in a safe, easily accessible place for short-term goals or emergencies. Think of saving as parking your money. The primary goal is not growth, it's preservation and accessibility. Investing, on the other hand, is the process of using your money to purchase assets with the expectation that they will grow in value over time. Think of investing as putting your money on a long-term journey. The primary goal is growth, which involves taking on a calculated level of risk. A healthy financial plan needs both. Let's start with the foundation, saving. Before you can confidently invest, it's crucial to have a safety net in place. This is your emergency fund. An emergency fund is exactly what it sounds like: a pool of money set aside for the unexpected and unwelcome surprises life can throw at you. A sudden job loss, an urgent medical issue, or a major home repair. These are the events that can force people into high-interest debt if they are not prepared. Your emergency fund is the financial firewall that protects you from that. How much should be in an emergency fund? A common guideline suggested by many financial experts is to have enough to cover 3 to 6 months' worth of essential living expenses. This would include costs like housing, utilities, food, and transportation. This isn't a rigid rule, but a goal to work toward. The purpose of this fund is purely defensive, so it should be kept in a place that is liquid and safe, meaning you can access it quickly and its value won't drop. For this reason, many people choose to keep their emergency fund in a high-yield savings account. Once your emergency fund is established, you can begin to focus on offense. on investing for your long-term goals. At its core, investing is the process of buying assets that you believe will increase in value. This could be anything from stocks and bonds to real estate. The goal is to grow your initial investment into a much larger sum over time, outpacing the rate of inflation, which is the general increase in the prices of goods and services that reduces the purchasing power of money. The engine that drives this growth is one of the most powerful forces in finance: the principle of compound growth, or compounding. Albert Einstein is often quoted as having called it the eighth wonder of the world. Compounding is the process where you earn a return not only on your original investment, but also on the accumulated returns from previous periods. Imagine a small snowball at the top of a very long hill. As you roll it, it picks up more snow, making it bigger. As it gets bigger, it picks up even more snow with each rotation. Compounding works just like that. In the beginning, the growth seems slow, but over many years, the process can accelerate dramatically, allowing your investments to grow at an exponential rate. This is why time is one of the most valuable assets an investor has. Of course, this potential for growth comes with a counterpart: risk. This brings us to a fundamental concept in investing: the risk and return trade-off. In general, assets with the potential for higher returns also come with higher risk. A savings account has very low risk, but it also offers very low returns. Stocks, which represent ownership in a company, have historically offered higher long-term returns, but they also come with higher risk, as their value can fluctuate significantly. Bonds, which are essentially loans to a government or corporation, typically fall somewhere in between. Understanding this trade-off is key. A central idea in managing investment risk is diversification. You've likely heard the old saying, "Don't put all your eggs in one basket." That is the essence of diversification. It is a strategy that involves spreading your investments across various assets to help reduce risk. Instead of buying just one company's stock, for example, a diversified portfolio might include many stocks, bonds, and other assets. For most individuals, a common way to achieve diversification is through vehicles like mutual funds or exchange-traded funds, ETFs. Think of these as a basket that holds a wide variety of different investments, sometimes hundreds or even thousands of stocks and bonds, all bundled together. Now, where do you hold these investments? In the US, there are special types of accounts that offer tax advantages to encourage people to invest for long-term goals, especially retirement. One of the most common is the 401k. This is a retirement savings plan sponsored by an employer. You contribute a portion of your paycheck, and sometimes your employer will offer a match. This means they will contribute money to your account on your behalf, often based on how much you contribute. This employer match is a powerful feature of these plans. If you don't have access to a 401k, or if you want to save more, there is the Individual Retirement Arrangement, or IRA. There are two main types. A traditional IRA may allow you to make contributions that are tax-deductible in the present, and your investments grow tax-deferred until you withdraw the money in retirement. A Roth IRA, on the other hand, is funded with money you've already paid taxes on. Its key feature is that your investments have the potential to grow completely tax-free, and qualified withdrawals in retirement are also tax-free. These accounts are simply the containers that hold your investments. The concepts of saving for emergencies and investing for the long term are the building blocks of a plan that can turn your income into lasting wealth. In our next chapter, we will tie all of this together by looking at the big picture: how to set meaningful financial goals and create a personal roadmap for your future. Hello and welcome back. Over the last 4 chapters, we have been assembling a powerful financial toolkit. We learned how to create a budget to command our cash flow, how to navigate the credit system, and how to put our money to work through saving and investing. We have all the component parts. Today, we're going to do something incredibly important. We're going to draw the map. This chapter is all about setting clear, meaningful financial goals that will serve as the destinations on your personal financial journey. Without a destination, even the most powerful car is just sitting in the driveway. Without a goal, a budget can feel restrictive and pointless. Financial goals are what give purpose to your daily financial decisions. They transform the act of saving money from a chore into a hopeful step toward a future you are actively building. Before we talk about the what, it's essential to start with the why. A financial plan is not just a collection of numbers on a spreadsheet. It's a reflection of your values. It's about what you want your life to look like. So take a moment to think about that. What does financial well-being mean to you? Is it the freedom to travel? The security of owning a home? The ability to provide opportunities for your family? The peace of mind that comes with being prepared for the unexpected? Your why is the fuel that will keep you going. Once you have a sense of your core values, you can begin to translate them into concrete financial goals. A great way to organize your thinking is to categorize your goals by their time horizon: short-term, mid-term, and long-term. Short-term goals are those you want to achieve in the next 1 to 3 years. These goals are often focused on building stability and security. A classic example is completing your emergency fund, which we discussed in the last chapter. Other short-term goals might include saving up for a much-needed vacation, paying off a specific high-interest credit card, or saving for a down payment on a new car. Mid-term goals are for objectives further down the road, typically in the 3 to 10-year range. These are often major life milestones. Saving for a down payment on a home is a very common mid-term goal. Others might include saving for a child's education, funding a small business venture, or planning for a major home renovation. Long-term goals are those that are more than a decade away. For nearly everyone, the most significant long-term financial goal is retirement. It's the process of building a large enough nest egg to support yourself when you no longer wish to, or are able to work. This goal can feel abstract and far away, but because of the power of compound growth, the actions you take toward it today are the most impactful ones you can make. Simply listing these goals is a great start, but to make them truly powerful, we need to make them clear and actionable. A widely used and effective framework for this is the SMART goal setting method. SMART is an acronym that stands for specific, measurable, achievable, relevant, and time-bound. Let's break that down. First, specific. A vague goal is hard to act on. Save more money is a wish, not a goal. A specific goal would be, I want to save money to build my emergency fund. Second, measurable. You need to be able to track your progress. How will you know when you've succeeded? To make our goal measurable, we would change it to, I want to save $6,000 for my emergency fund. Third, achievable. A goal needs to be realistic based on your current situation. If your budget shows you have $200 left over each month, setting a goal to save $10,000 in 6 months is not achievable and will only lead to frustration. A more achievable goal would be, based on my budget, I can realistically set aside $200 per month toward my emergency fund. Fourth, relevant. Does this goal matter to you? Does it align with your values? For our example, the answer is yes. Having an emergency fund is relevant to my desire for financial security and peace of mind. Finally, time-bound. A goal needs a deadline. This creates a sense of urgency and provides a clear timeline for your plan. Putting it all together, our vague wish to save more money has been transformed into a SMART goal. I will save $6,000 for my emergency fund by automatically transferring $200 from my checking to my savings account each month for the next 30 months. Do you see the difference? That is a plan. That is a concrete action you can take. You can apply this framework to any financial goal, big or small. From saving for a home to planning for retirement. A goal like, invest for retirement becomes, I will contribute a specific percentage of my income to my retirement account with every paycheck. This is where all the pieces of our financial literacy puzzle snap together. You use your budget to identify the money you can allocate to your goals. You use your understanding of debt and credit to inform your strategy, helping you decide how to balance paying down debt with saving. And you use your knowledge of saving and investing to choose the appropriate tools for your goals' time horizon. Short-term goals, like building an emergency fund, typically use safe and liquid savings vehicles. Long-term goals, like retirement, often involve investing to leverage the power of compound growth over many years. This entire process creates your financial plan. It doesn't have to be a 100-page document created by a professional. At its heart, a financial plan is simply your personal roadmap, outlining where you are now, where you want to go, and the steps you will take to get there. It puts you in the architect's seat of your own future. In our next chapter, we'll address the final core pillar of financial literacy: how to protect the life you are building. We will explore the world of risk management and insurance. Hello and welcome back. In our journey so far, we have focused on building a positive financial future. We've created a budget to direct our money, learned to navigate debt and credit, started a plan for saving and investing, and set meaningful goals to guide us. We have, in essence, been designing and building our financial house. Today, we're going to talk about how to protect that house. This chapter is dedicated to the final pillar of financial literacy: risk management and insurance. Risk management is a straightforward concept. It's the process of identifying potential threats to your financial well-being and taking steps to protect yourself from them.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Life is inherently unpredictable. While we can't stop unexpected events from happening, we can put a plan in place to manage their financial impact. The most powerful tool we have for this is insurance. If your savings and investments are your financial offense, the way you score points and move forward, then insurance is your defense. It's the safety net that catches you when you fall, preventing a single unfortunate event from undoing years of hard work and careful planning. So how does insurance actually work? At its core, insurance is a system of risk transfer. You transfer the risk of a large, potentially catastrophic financial loss to an insurance company. In exchange for this protection, you pay the company a smaller, predictable amount of money on a regular basis. This payment is called a premium. By pooling the premiums from thousands or millions of people, the insurance company has the funds to pay out claims for the few who experience a covered loss in a given year. It's a collective way of sharing risk, so that no single person has to bear the full weight of a disaster. Before we explore the different types of insurance, let's quickly define a few key terms you'll encounter. A policy is the formal contract you have with the insurance company that outlines the terms of your coverage. Coverage refers to the specific protections and benefits provided by your policy. A deductible is the amount of money you are required to pay out of pocket for a claim before the insurance company's coverage kicks in. And a claim is the formal request you submit to the insurance company to receive payment for a covered loss. With that foundation, let's look at the major types of insurance and the specific risks they are designed to manage. First is health insurance. In the United States, the cost of medical care can be extraordinarily high. A single hospital stay or major procedure can easily lead to bills in the tens or even hundreds of thousands of dollars. Health insurance is designed to protect you from these potentially devastating costs. It covers a range of medical services, from doctor visits and prescription drugs to emergency room care and surgery. For many Americans, health insurance is provided through an employer, but it can also be obtained through government marketplaces or from private insurers. Next is auto insurance. If you own and drive a vehicle, auto insurance is essential. In fact, nearly every state legally requires you to have at least a minimum level of liability coverage. Its primary purpose is to protect you financially in the event of an accident. Liability coverage helps pay for damages you may cause to another person's vehicle or for their medical expenses if they are injured. Other common coverages, like collision and comprehensive, help pay for damages to your own vehicle, whether from an accident, theft, or a natural event like a hailstorm. Similarly, homeowners and renters insurance protect your living space and your personal belongings. If you own a home, homeowners insurance covers damage to the structure itself, as well as your possessions inside from events like a fire or a tornado. It also typically includes liability protection in case someone is injured on your property. If you rent, renters insurance serves a similar purpose, but for your personal property within the apartment or house you're renting. And it also provides liability coverage. Now let's discuss disability insurance. One of your greatest assets is your ability to earn an income. What would happen if an illness or injury prevented you from working for an extended period? This is the risk that disability insurance is designed to cover. It's often called paycheck protection, because if you become disabled and unable to work, the policy will replace a portion of your monthly income, allowing you to continue paying your bills and maintaining your lifestyle while you recover. Finally, there is life insurance. This type of insurance is designed to provide financial protection for your loved ones in the event of your death. The policy provides a tax-free, lump sum payment, known as a death benefit, to your chosen beneficiaries. The purpose of this money is to help replace your lost income, cover funeral expenses, pay off a mortgage, or fund a child's education. There are two primary categories of life insurance. Term life insurance provides coverage for a specific period of time, such as 20 or 30 years. Permanent life insurance, such as whole life, provides lifelong coverage and includes a cash value component that can grow over time. Insurance might feel like just another bill to pay, but its role in a sound financial plan is critical. It is the defensive strategy that stands guard over your assets, your goals, and your family's future, ensuring that your financial house can withstand the inevitable storms of life. Now that we have covered the 5 main pillars of financial literacy, our next chapter will dive deeper into a practical, everyday topic that combines several of these elements. understanding your paycheck and making the most of your employee benefits. Hello and welcome back. In our journey so far, we have explored the high-level pillars of financial literacy: budgeting, credit, investing, goal setting, and insurance. Today we're going to bring these concepts down to earth and look at the single most important document in most people's financial lives: the paycheck. For many of us, our paycheck is the primary engine of our entire financial plan. It's the income that funds our budget, pays down our debts, and builds our investments. Yet, the pay stub that accompanies that check can often feel like a complex puzzle, filled with unfamiliar terms and a confusing list of deductions. This chapter is designed to be your guide to decoding that puzzle. Understanding exactly where your money is going before it even reaches your bank account is a critical step in taking full control of your finances. Let's start by breaking down the typical pay stub into its three main sections: gross pay, deductions, and net pay. The first number you'll usually see is your gross pay. As we touched on in Chapter 2, this is the total amount of money you earned during the pay period before anything was taken out. If you're an hourly employee, this is your hourly wage multiplied by the number of hours you worked. If you're a salaried employee, this is a portion of your annual salary, divided by the number of pay periods in a year. This is your starting number, your top-line earnings. Next comes the most detailed section: deductions. This is where you see the difference between your gross pay and what you actually take home. These deductions can be broken down into two main categories: pre-tax and post-tax. Pre-tax deductions are amounts subtracted from your gross pay before income taxes are calculated. This is an important feature because these deductions lower your overall taxable income, which can reduce the amount of tax you owe. Let's look at the most common pre-tax deductions. Federal and state income tax. This is the estimated amount of tax you owe to the U.S. government and, in most cases, your state government. This money is withheld by your employer and sent to the tax authorities on your behalf. The amount withheld is based on the information you provide on a Form W-4 when you start a job. This form communicates your tax filing status and other details to your employer, so they can estimate the appropriate amount to withhold. FICA taxes. This is another type of federal tax, and it stands for the Federal Insurance Contributions Act. FICA is made up of two separate taxes: Social Security and Medicare. These funds are used to pay for these national social insurance programs. You pay a percentage of your income, and your employer is required to pay a matching amount on your behalf. 401k or other retirement plan contributions. If you are participating in a workplace retirement plan like a 401k, your contributions are typically made on a pre-tax basis. This money is taken from your paycheck and deposited directly into your retirement investment account. Health insurance premiums. This is your share of the cost for any health, dental, or vision insurance plans you have through your employer. The amount you pay is deducted from your paycheck before taxes. After pre-tax deductions, there may be post-tax deductions. These are amounts taken out after all the necessary taxes have been calculated. A common example would be contributions to a Roth 401k plan. As we discussed in a previous chapter, the key difference is in the tax treatment. You pay taxes on the money now, in exchange for the potential for tax-free withdrawals in retirement. After all these deductions are subtracted from your gross pay, you are left with the final, and most anticipated, number: your net pay. This is your take-home pay, the actual amount of money that gets deposited into your bank account. The simple formula is: gross pay minus all deductions equals net pay. It is this net pay figure that you will use to fund your monthly budget. But your paycheck is only part of the story. A crucial element of financial literacy is understanding that your total compensation is much more than just your salary. The employee benefits your employer offers have significant financial value. Think about the employer-sponsored retirement plan we just mentioned. If your employer offers a 401k match, this is a direct and powerful part of your compensation. For example, if you earn $60,000 a year and your employer matches your contributions up to 5% of your salary, that is an extra $3,000 per year that your employer is adding to your retirement account. Consider health insurance. When you see that premium deducted from your paycheck, remember that this is usually only a fraction of the total cost. Employers often cover a large majority of the monthly premium for health, dental, and vision insurance. This is a substantial, non-taxable benefit that adds thousands of dollars to your total compensation package. Many employers also offer other forms of insurance as a benefit, such as a basic group life insurance policy or disability insurance. As we learned in our last chapter, these are designed to protect you and your family from catastrophic financial loss. Don't forget about paid time off, PTO. Your vacation days? holidays, and sick leave are all part of your compensation. It's a direct payment for time that you are not working. Finally, some employers offer tax-advantaged accounts to help with medical costs, like a health savings account, HSA, or a flexible spending account, FSA. These accounts allow you to set aside pre-tax money specifically for qualified healthcare expenses. By looking beyond the net pay and understanding your entire compensation package, you get a true picture of the financial resources at your disposal. This knowledge empowers you to budget more effectively and make informed decisions that can accelerate your progress toward your financial goals. In our next chapter, we will begin to explore some of those major financial goals in greater detail, starting with one of the biggest for many Americans: the path to homeownership. Hello and welcome back. For many people in the United States, owning a home is a cornerstone of the American dream. It represents stability, community, and a place to call your own. It is also, without a doubt, one of the most significant financial decisions you will ever make. Because this is such a major life goal for so many, we're dedicating this chapter to outlining the path to homeownership. Our goal here is not to tell you whether you should buy a home, or what kind of home to buy. Instead, this chapter will serve as your high-level roadmap. We'll walk through the key phases of the process, define the terminology, and connect it all back to the financial literacy principles we've been building, so you can understand the journey ahead. The path to homeownership begins long before you start looking at listings online. It starts with financial preparation. The first major financial hurdle is the down payment. This is the portion of the home's purchase price that you pay up front in cash. The rest of the price is covered by the mortgage loan. You may have heard the common guideline of needing a 20% down payment. Putting down 20% is a traditional benchmark because it typically allows a borrower to avoid paying for private mortgage insurance, or PMI. PMI is a type of insurance that protects the lender, not you, in case you are unable to continue making your mortgage payments. While a 20% down payment is a worthy goal, it's important to know that many loan programs exist today that allow for down payments as low as 3 to 5%, or even 0% in some specific cases. However, the down payment isn't the only cash you'll need. You also have to plan for closing costs. These are the fees you pay to complete the real estate transaction. They cover services like the loan origination, the property appraisal, the title search, and other legal and administrative paperwork. As a general rule of thumb, closing costs are often estimated to be in the range of 2% to 5% of the total loan amount, so they are a significant expense to factor into your savings plan. As you save, it's also the time to focus on your credit health. As we discussed in Chapter 3, your credit score plays a starring role in the mortgage process. Lenders use it to determine if you qualify for a loan and, just as importantly, what interest rate they will offer you. A higher credit score can translate into a lower interest rate, which can save you tens of thousands of dollars over the life of the loan. Lenders will also look closely at a key metric called your debt-to-income ratio, or DTI. This is a percentage that shows how much of your gross monthly income is used to pay your recurring monthly debts, things like a car payment, student loans, and credit card payments. Lenders use DTI as a way to gauge your ability to comfortably manage a new mortgage payment on top of your existing obligations. Once your finances are in order, the next phase is the mortgage process. A great first step is to get a mortgage pre-approval. This is different from a pre-qualification, which is just a rough estimate. For a pre-approval, you submit your financial documents, like pay stubs, tax returns, and bank statements, to a lender. They will review your finances and provide a conditional commitment to lend you a specific amount of money. A pre-approval letter shows sellers that you are a serious, qualified buyer. During this process, you will learn about different types of mortgages. A fixed-rate mortgage has an interest rate that is locked in for the entire term of the loan, meaning your principal and interest payment will never change. An adjustable-rate mortgage, or ARM, typically has a lower introductory interest rate for a fixed period, after which the rate can adjust up or down based on market conditions. There are also government-insured loans, such as FHA and VA loans, which have their own specific criteria and features. With a pre-approval in hand, you can begin the exciting part: the home search and purchase process. This is where you assemble your team. A real estate agent can help you find homes, navigate the market, and represent your interests when you make an offer. Once your offer is accepted, a real estate attorney or title company will handle the legal side of the transaction, ensuring the property's title is clear. Before the sale is final, you will have a crucial step called the home inspection. A professional inspector will thoroughly examine the property's condition, from the roof to the foundation, and provide a detailed report. This gives you an opportunity to identify any major issues before you are legally committed to the purchase. While this is happening, your lender will be conducting the underwriting process, which is a deep dive to verify all of your financial information. They will also order an appraisal to have an independent professional determine the home's market value to ensure it supports the loan amount. The final step is the closing. This is where you sign a mountain of paperwork, pay your down payment and closing costs, and are officially handed the keys. You are now a homeowner. But the costs don't stop there. It's vital to remember the ongoing costs of homeownership beyond the monthly mortgage payment. These include property taxes, homeowners insurance, regular maintenance, unexpected repairs, and potentially homeowners association fees. These should all be factored into your new monthly budget. The path to homeownership is a marathon, not a sprint. It requires careful planning and financial discipline. Understanding the steps involved is the first move toward navigating it with confidence. In our next chapter, we will tackle another major topic that affects everyone's financial life: an introduction to the U.S. tax system. Hello and welcome back. In our journey, we've talked about earning, saving, spending, borrowing, and investing. Now we're going to discuss the one financial topic that connects to all of those activities: taxes. For many, the U.S. tax system can feel like an incredibly complex and intimidating subject. The goal of this chapter is not to turn you into a tax expert or to provide any form of tax advice. Instead, our aim is to demystify the system. We'll break down the fundamental purpose of taxes, define the key terms you need to know, and explain the basic mechanics of how it all works. First, let's start with the why. What is the purpose of taxes? At the most basic level, taxes are how we collectively pay for the society we live in. The money collected by federal, state, and local governments is used to fund a vast array of public services. This includes building and maintaining our infrastructure, like roads, bridges, and airports. It funds our education system, our national defense, scientific research, and our parks. It also pays for critical social programs like Social Security for retirees, Medicare for seniors, and Medicaid for low-income individuals. Taxes are the financial engine of public life. The primary tax that most individuals interact with is the federal income tax. The U.S. federal income tax system is what's known as a progressive tax system. This is a fundamental concept to understand. It means that people with higher taxable incomes are subject to progressively higher tax rates. This system is organized into tax brackets. This is where a major misconception often arises. Being in a certain tax bracket, say the 22% bracket, does not mean that all of your income is taxed at 22%. That's not how it works. Instead, different portions of your income are taxed at different rates. For example, the first portion of your income is taxed at the lowest rate, the next portion is taxed at the next rate, and so on up to your total income. Only the portion of your income that falls within a specific bracket is taxed at that bracket's rate. The amount of tax you ultimately owe is not based on your gross pay, but on your taxable income. This is your gross income minus any eligible adjustments and deductions. Let's define what deductions are. A deduction is an amount of money that the IRS allows you to subtract from your gross income to lower the amount that is subject to tax. Most taxpayers have a choice between taking the standard deduction or itemizing deductions. The standard deduction is a fixed dollar amount, determined by law, that depends on your filing status, your age, and other factors. It's a straightforward way to reduce your taxable income without having to track a list of expenses. Itemized deductions, on the other hand, allow you to list out specific eligible expenses. Common examples include deductions for state and local taxes, mortgage interest, and charitable contributions. A taxpayer will generally use whichever method. The standard deduction or itemizing results in a larger deduction and therefore a lower tax bill. Next, it's important to understand the difference between a deduction and a tax credit. While they both help reduce your tax burden, they work in different ways. As we just learned, a deduction reduces your taxable income. A tax credit, however, is even more powerful. It directly reduces your final tax bill, dollar for dollar. For example, a $1,000 tax credit will reduce the amount of tax you owe by the full $1,000. There are various tax credits available that are designed to benefit certain groups, such as families with children or students paying for higher education. Every year, U.S. citizens and residents are required to report their income and calculate the tax they owe to the government through a process called filing a tax return. Throughout the year, you receive various tax forms. If you're an employee, you get a Form W-2 from your employer at the beginning of the year. This form summarizes your total earnings and shows how much income tax and FICA tax was already withheld from your paychecks. If you are self-employed or have other sources of income, you might receive 1099 forms. You use the information from these and other documents to fill out your tax return, most commonly on Form 1040. This form is where you state your income, claim your deductions and credits, and calculate your total tax liability for the year. The deadline to file this return is typically April 15th. The purpose of filing is to reconcile the amount of tax you should have paid with the amount of tax that was actually withheld from your paychecks. If the amount withheld was more than what you actually owed, you will receive a tax refund. If the amount withheld was less than what you owed, you will need to pay the remaining balance. It's helpful to remember that a refund isn't a gift from the government. It's simply your own money being returned to you because you overpaid during the year. It is critical to state that tax laws are complex and can change from year to year. This chapter is for general informational and educational purposes only. For guidance on your specific tax situation, it is always best to consult official government resources, like the IRS website, or to work with a qualified tax professional. In our next chapter, we will return to one of the most important long-term goals we've discussed: preparing for the future by taking a closer look at retirement planning. Hello and welcome back. We've covered a wide range of financial topics, from the daily practice of budgeting to the major life goal of homeownership. Today, we turn our attention to what is, for many, the ultimate long-term financial goal: retirement. When we hear the word retirement, we often picture a specific age or a finish line where we stop working. But a more empowering way to think about retirement is as a transition to a new phase of life. A phase where work becomes a choice, not a necessity. It's about having the financial freedom to pursue passions, spend time with family, or simply live life on your own terms. For those who are just starting their careers, this can feel like a goal that is a lifetime away, almost too distant to worry about. But the single most powerful tool you have on your side is time. Because of the principle of compound growth we discussed earlier, the actions you take in your 20s and 30s have a far greater impact than the actions you take in your 50s and 60s. A small amount invested early on has the potential to grow into a much larger sum than a bigger amount invested later, simply because it has more decades to compound. Planning for retirement is truly a lifelong journey, and the sooner you start, the smoother the path will be. To understand the modern approach to retirement, it's helpful to know about a classic analogy: the three-legged stool. For generations, retirement income was seen as being supported by three legs: a company pension, Social Security, and personal savings. Today, that stool looks very different for most Americans. The first leg, the traditional company pension, where a company guarantees you a set income for life, has become increasingly rare in the private sector. The second leg, Social Security, remains a critical part of the system. It is a federal program that provides a baseline of income for retirees, funded by the FICA taxes we all pay. However, Social Security was designed to supplement retirement income, not be the sole source of it. This means that for most people, the third leg of the stool, personal savings and investments, has become the largest and most important. The responsibility for building a secure retirement now rests primarily on our own shoulders, which is why financial literacy in this area is so critical. The primary vehicles for these personal savings are the tax-advantaged retirement accounts we've introduced before, like the 401k and the Individual Retirement Arrangement, IRA. The 401k, or similar plans like the 403b for nonprofit employees, is the cornerstone of retirement savings for many working Americans. As we've mentioned, one of its most powerful features is the potential for an employer match. If your employer offers to match your contributions up to a certain percentage, contributing enough to receive the full match is a foundational step in retirement saving. Within these plans and with IRAs, you'll often see the choice between traditional and Roth accounts. The difference lies in how they are treated for tax purposes. With a traditional 401k or IRA, your contributions may be tax-deductible now, which lowers your taxable income today. Your money then grows tax-deferred, and you pay income taxes on the withdrawals you make in retirement. With a Roth 401k or IRA, you contribute with money you've already paid taxes on, so there's no upfront tax deduction. The major potential benefit is that your investments can grow completely tax-free, and qualified withdrawals in retirement are also tax-free. Understanding this pay taxes now or pay taxes later distinction is a key part of retirement education. Another important concept with employer plans is vesting. While the money you contribute is always 100% yours, the money your employer contributes through a match may have a vesting schedule. This means you have to work for the company for a certain period, often a few years, to gain full ownership of those matching funds. This all leads to the big question everyone has. How much do I actually need to save for retirement? There is no single magic number that works for everyone. The amount you'll need is highly personal and depends on factors like your desired lifestyle in retirement, your health, where you want to live, and how long you expect to live. However, financial professionals often use some general rules of thumb as a starting point for discussion. One common guideline is the 80% rule, which suggests you may need about 80% of your pre-retirement annual income to maintain a similar lifestyle after you stop working. Another concept you may hear about is the 4% rule, which is a guideline related to how much you might be able to safely withdraw from your retirement savings each year, without depleting it too quickly. These are not ironclad laws, but rather conceptual tools used in financial planning to help estimate goals and strategies. Ultimately, retirement planning is not a set-it-and-forget-it task. It's a dynamic process of setting goals, saving consistently, and periodically reviewing your progress. The key takeaway is that every dollar you invest in your future self is a step toward financial freedom. In our next chapter, we'll look at another important long-term savings goal that many families face: planning and saving for college and other educational expenses. Hello and welcome back. We've spent the last chapter focused on the long-term goal of retirement, a journey that spans an entire career. Today, we're going to discuss another significant, and often overlapping, long-term financial goal that many American families face: saving for higher education. The rising cost of college is a well-known reality, and for parents, grandparents, and students alike, it can be a major source of financial stress. The purpose of this chapter is to provide an educational overview of this challenge. We will explore the common savings tools and concepts related to planning for education expenses. Our goal is to empower you with knowledge so you can better understand the landscape of saving for this important milestone. Much like retirement planning, the most powerful factor on your side when saving for education is time. The principle of compound growth works the same way. A smaller amount of money set aside when a child is young has the potential to grow far more significantly than a larger amount saved when they are a teenager. Starting early can dramatically reduce the financial burden down the road. One of the first challenges is aiming for a moving target. The cost of a 4-year degree today is not what it will be in 10, 15, or 18 years from now. When planning, it's important to account for the effects of inflation on education costs. There are many online college cost calculators that can help families estimate the future cost of attendance at various types of schools, providing a clearer picture of the savings goal they are working toward. To help families save for this goal, there are specific tax-advantaged accounts designed for education savings. Let's discuss a few of the most common types. The most widely used and well-known tool is the 529 plan. Named after the section of the tax code that created it, a 529 plan is an investment account that offers significant tax benefits when used for education. These plans are sponsored by individual states, but you are generally not restricted to using your own state's plan. The key features of a 529 plan are its tax advantages. While contributions are typically made with post-tax dollars, any investment growth within the account is tax-deferred. Then, when the money is withdrawn to pay for qualified education expenses, those withdrawals are completely free from federal income tax. Many states also offer a state income tax deduction or credit for contributions made to their own plan. What are qualified expenses? Traditionally, this has meant costs associated with college, such as tuition and fees, room and board, books and supplies, and necessary computer equipment. However, the use of 529 plans has expanded. They can now often be used for up to $10,000 per year for K-12 tuition and expenses, for costs associated with registered apprenticeship programs, and even for paying back a certain amount of student loan debt. A 529 plan has an account owner, typically a parent or grandparent, and a designated beneficiary, the student. The owner maintains control over the account and the investments. If the original beneficiary decides not to pursue higher education, the owner generally has the option to change the beneficiary to another eligible family member. Another type of account is the Coverdell Education Savings Account (ESA). It functions similarly to a 529 plan, offering tax-free growth and tax-free withdrawals for qualified education expenses, which also includes K-12 costs. However, Coverdell ESAs have much lower annual contribution limits.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Currently $2,000 per year per beneficiary, and there are income restrictions on who can contribute to them. Finally, there are custodial accounts, known as UTMA or UGMA accounts. These are not specifically for education, but are a way to hold and manage assets for a minor. Once you contribute money to a custodial account, it is an irrevocable gift that legally belongs to the child. The custodian manages the money until the child reaches the legal age of adulthood in their state, at which point they gain full control of the funds and can use them for anything they wish, not just education. It's also important to know that because the money is considered an asset of the student, it can have a greater impact on their eligibility for need-based financial aid compared to a parent-owned 529 plan. This brings us to a critical part of the college funding puzzle: financial aid. For most families, paying for college involves a combination of savings, income, and financial aid. The process typically begins by filling out the FAFSA, which stands for the Free Application for Federal Student Aid. The information on this form is used to determine a student's eligibility for various types of aid, including grants and scholarships, which are gift aid that doesn't need to be repaid, work-study programs, which provide on-campus jobs, and student loans, which must be repaid. A common question that arises is how to balance saving for education with saving for retirement. This is a significant consideration for many families. While this series cannot offer advice on this, a principle often cited by financial planners is that a student can get a loan for college, but you cannot get a loan for retirement. This concept encourages individuals to understand the importance of securing their own financial future first. Planning for education is a major undertaking, but understanding the tools and processes involved can make the goal feel much more achievable. In our next chapter, we will shift our focus to another practical aspect of modern financial life: understanding and navigating the world of digital banking and online payments. Hello and welcome back. In our journey through financial literacy, we've explored timeless principles of budgeting, saving, and investing. Today, we're going to focus on the tools we use to manage these principles in the 21st century. We'll be diving into the world of digital banking and online security. Not long ago, managing your money meant physically going to a bank branch, waiting in line, and interacting with a teller. While that is still an option, the financial world has undergone a massive digital transformation. Today, the bank is in your pocket, on your laptop, and available 24 hours a day. These digital tools offer incredible convenience and control, but they also require a new layer of awareness and vigilance. Let's start by defining the key components of the digital banking landscape. Online banking is the ability to access and manage your bank accounts through your financial institution's website on a computer. From here, you can perform a wide range of tasks. Check your account balances in real time, review your transaction history, transfer money between accounts, pay your bills using a bill pay service, and access your monthly statements without waiting for them in the mail. Mobile banking takes this a step further by putting all that functionality into a dedicated app on your smartphone or tablet. Mobile banking apps often include additional features, with one of the most popular being Mobile Check Deposit, which allows you to deposit a check simply by taking a picture of it with your phone's camera. In recent years, we've also seen the rise of peer-to-peer, P2P, payment services. These are apps and services that allow you to send money directly to another person using your phone. They are incredibly convenient for things like splitting a dinner bill with a friend or paying a babysitter. It is helpful to think of these transactions like handing someone cash. The transfer is often instant and irreversible, so it is a common best practice to only send money to people you personally know and trust. Finally, you have digital wallets. These are services built into your smartphone that securely store your debit and credit card information. This allows you to make payments at a store by simply tapping your phone on the payment terminal, a technology known as contactless payment. The benefits of these tools are clear. They provide instant access, save time, and can even help you manage your money more effectively. You can set up automatic bill payments to avoid late fees or schedule recurring transfers to your savings account, automating the pay-yourself-first principle we discussed earlier. However, with this convenience comes the responsibility of protecting your financial information. This brings us to the other side of the coin: online security. The foundation of your online financial security is strong authentication. This starts with your passwords. A strong password is not an easily guessable word. The key characteristics are length and complexity. It should be long, and it should contain a mix of uppercase and lowercase letters, numbers, and symbols. Just as importantly, you should use a unique password for every single financial account. To manage this, many people use tools known as password managers, which can generate and securely store complex, unique passwords for all of your sites. Beyond a password, one of the most effective security measures you can enable is multi-factor or two-factor authentication, often called MFA or 2FA. This adds a second layer of security to the login process. Even if someone manages to steal your password, they still can't access your account without the second factor, which is typically a temporary code sent to your phone via text message or generated by a special authenticator app. It's also crucial to be able to identify common online scams. A prevalent threat is phishing. This is when a scammer sends you an email that looks like it's from your bank or another legitimate company, but is actually designed to trick you into revealing personal information. A text message version of this is called smishing. These fraudulent messages often have telltale signs. They might create a false sense of urgency, claiming your account is locked or has a problem that requires immediate action. They may use generic greetings like "Dear Customer," and they often contain spelling or grammar mistakes. Most importantly, they will try to get you to click on a suspicious link or open a malicious attachment. The single most important thing to remember is that your bank will almost never ask you to provide your password, PIN, or other sensitive account details in an email or text message. Another key practice is to be mindful of your network connection. Your home Wi-Fi network, if it is password protected, is a secure environment. Public Wi-Fi, like the kind you find at coffee shops, airports, or hotels, is not. It's a widely held security principle to avoid logging into your bank or making other financial transactions while connected to public Wi-Fi. Finally, one of the best habits you can build is to monitor your accounts regularly. Instead of waiting for a monthly statement, you can log into your online or mobile banking portal weekly, or even daily to review your recent transactions. Many banks also allow you to set up alerts that will automatically send you a text or email for specific activities, such as a purchase over a certain amount or an online login. This allows you to spot any unauthorized activity almost immediately. If you ever suspect your account has been compromised, the first and most important step is to contact your financial institution directly and immediately. Federal law often provides protections that can limit your liability for fraudulent transactions, but these protections are dependent on you reporting the issue promptly. In our next chapter, we will expand on this theme of protection by exploring your rights as a consumer and taking a deeper look at how to identify and avoid common financial scams. Hello and welcome back. So far in our series, we've focused on the proactive side of financial literacy, how to budget, save, invest, and plan for your goals. Today, we're going to focus on the defensive side. Being financially literate isn't just about managing your money well, it's also about protecting yourself in the marketplace. This chapter is dedicated to helping you become a savvy consumer by understanding your basic rights and learning how to recognize and avoid common financial scams. In the United States, the marketplace operates on the idea that consumers have fundamental rights. This concept was famously outlined in the Consumer Bill of Rights, which includes principles like the right to safety, the right to be informed, the right to choose, and the right to be heard. To uphold these rights, various government agencies work to protect consumers. The Federal Trade Commission, or FTC, works to stop unfair and deceptive business practices, while the Consumer Financial Protection Bureau, or CFPB, oversees financial products and services to ensure people are treated fairly. Knowing that this protective framework exists is the first step. The next is to understand some of the specific rights you have in key financial areas. Let's start with your credit. The Fair Credit Reporting Act, FCRA, is a federal law designed to ensure that the information on your credit reports is accurate, fair, and private. Under this law, you have the right to request and receive a free copy of your credit report from each of the 3 major credit bureaus every year. You also have the powerful right to dispute any information on your report that you believe is inaccurate. The credit bureau and the information provider are then required to investigate the dispute. Next, let's talk about debt collection. The Fair Debt Collection Practices Act, FDCPA, provides a set of rules that debt collectors must follow. Its purpose is to protect consumers from abusive, unfair, or deceptive collection tactics. For example, this act sets limits on when a collector can contact you, generally prohibiting calls before 8 a.m. or after 9 p.m. It also forbids collectors from using harassment, threatening violence, or making false statements, such as pretending to be a law enforcement officer. When you borrow money, you are protected by the Truth in Lending Act, TILA. This law requires lenders to provide you with clear and standardized disclosures about the terms and costs of credit. This is why when you get a loan or credit card, you see the term APR, or annual percentage rate. The APR represents the total annual cost of borrowing money, and this law ensures it is disclosed in a uniform way so you can compare offers from different lenders. Understanding these rights is your first line of defense. Your second is learning to recognize the warning signs of a scam. Scammers are constantly inventing new schemes, but they often rely on the same old tricks that prey on our emotions, like fear, excitement, and a desire to help. One of the most widespread categories is the imposter scam. This is when a scammer pretends to be someone you know or trust. They might call or email claiming to be from a government agency, like the IRS or the Social Security Administration, threatening you with arrest or fines if you don't pay them immediately. Remember, legitimate government agencies will almost never initiate contact this way, or demand immediate payment with threats. Other imposters may pose as tech support, claiming your computer is infected with a virus, or they might pretend to be a family member, like a grandchild, who is in trouble and needs money wired urgently. Another major category is the too good to be true scam. This includes fake lottery or sweepstakes notifications claiming you've won a huge prize, but first you have to pay a small fee, or tax, to receive it. A legitimate lottery will never ask you to pay to claim a prize. This category also includes investment scams that promise guaranteed high returns with zero risk, which is a combination that simply does not exist in the world of legitimate investing. You should also be aware of job scams. Scammers post fake job listings, often for attractive work-from-home positions. After hiring you, they will tell you that you need to pay them for training materials or special equipment. A real employer will never ask you to pay them to start a job. While the stories may change, the red flags of a scam are often the same. Be on high alert if you encounter extreme pressure to act immediately. Scammers don't want you to have time to think. A request for payment through an unusual method. They often demand payment via wire transfer, gift cards, or cryptocurrency because these methods are difficult to trace and reverse. A request for your personal or financial information, like a password, social security number, or bank account number. A promise that simply sounds too good to be true. The most powerful tool you have against scams is a healthy sense of skepticism. Before you act, especially when emotions are high and money is on the line, always take a moment to pause, think, and independently verify the information. In our next chapter, we will explore a growing and important part of the modern economy, navigating the finances of the gig economy and managing a variable income. Hello and welcome back. Throughout this series, many of our examples have been based on the traditional model of employment, a steady paycheck from a single employer. But the way people work is changing. Millions of Americans now earn their living in what is known as the gig economy. This includes freelancers, independent contractors, small business owners, and side hustlers. If you are one of these individuals, you are essentially the CEO and CFO of your own career. This offers incredible freedom and flexibility, but it also presents a unique set of financial challenges. The biggest of these is managing a variable income. Unlike a fixed salary that arrives in the same amount on the same day, your income might fluctuate significantly from month to month. One month could be a feast, and the next could feel like a famine. This chapter is dedicated to exploring the financial principles and strategies that can help you thrive in this dynamic environment. The first and most fundamental shift in mindset is moving from a monthly budget to a more holistic cash flow plan. When your income is unpredictable, your financial foundation needs to be even stronger. This starts with your emergency fund. As we've discussed, a standard recommendation is to have 3 to 6 months of living expenses saved. For those with a variable income, many financial educators suggest aiming for a more substantial buffer, perhaps 6 to 12 months worth. This larger safety net provides the peace of mind and stability needed to ride out slower months, without going into debt or feeling stressed. The next challenge is smoothing out that inconsistent income to create a sense of predictability. A powerful and widely used strategy for this is the pay yourself a salary method. Here's how this concept works. You set up at least 2 separate bank accounts. One is your business account, and the other is your personal checking account. All the income you earn from your work is deposited directly into your business account. This account becomes a holding tank for all your revenue. Then, based on a careful assessment of your average earnings and essential personal expenses, you decide on a fixed, consistent salary for yourself. On a regular schedule, say the 1st and 15th of every month, you pay yourself by transferring that fixed salary amount from your business account to your personal account. This simple act creates a predictable personal cash flow, even when your business income is volatile. In high-earning months, extra money will accumulate in your business account, building a surplus. In lower earning months, you can draw from that surplus to continue paying your consistent personal salary. This method forces you to live on a calculated average rather than your peak earnings, which is a key discipline for long-term success. Another crucial adjustment is in how you handle taxes. When you are a traditional employee, your employer withholds taxes from your paycheck and sends them to the government on your behalf. When you are an independent contractor, you are responsible for paying your own taxes. This includes not just federal and state income tax, but also self-employment tax, which covers your contributions to Social Security and Medicare. A foundational habit for every gig worker is to set aside a portion of every single payment you receive for taxes. The exact percentage will vary based on your income and location, but a common rule of thumb is to set aside somewhere between 25% to 35% of your gross income into a separate savings account specifically for taxes. This is not your money to spend. By doing this consistently, you ensure you have the funds ready when it's time to pay the government. Most self-employed individuals are required to pay these taxes to the IRS in 4 installments throughout the year, a process known as making quarterly estimated tax payments. Finally, being self-employed means you are also responsible for providing your own benefits. This is a major financial planning consideration. For health insurance, you will need to find your own coverage, often through the health insurance marketplace or private insurers. For retirement, you can't rely on an employer's 401k. However, you have access to powerful retirement savings accounts designed for the self-employed, such as a SEP IRA or a solo 401k. These accounts often allow you to save a much larger amount of your income for retirement than a traditional IRA. Managing a variable income requires a higher level of financial discipline and proactive planning. It means being more diligent with your budgeting, more conservative with your spending, and more intentional about saving for both short-term needs and long-term goals. By embracing these principles, you can build a stable and prosperous financial life on your own terms. In our final chapter, we will bring all of these concepts together and talk about how to build a lifelong habit of financial wellness. Hello, and welcome back for the final chapter of our series. We have traveled a long way together on this journey toward financial literacy. We started with the most basic question: what is financial literacy? And along the way, we've explored everything from budgeting and credit to investing, insurance, and taxes. If you have followed along, you have given yourself a powerful gift, the gift of knowledge. In this final chapter, we're not going to introduce new, complex topics. Instead, we're going to tie everything together and focus on a single, overarching concept: financial wellness. Financial wellness is not about being rich. It's not about having a certain number in your bank account or never having to worry about money again. Financial wellness is a state of being. It's the feeling of control you have over your day-to-day and month-to-month finances. It's the capacity to absorb a financial shock. It's being on track to meet your life goals. And ultimately, it is the freedom to make choices that allow you to enjoy life. It is the ultimate goal of everything we have learned. Looking back, our entire journey was built upon 5 foundational pillars. We started with budgeting, which is the pillar of awareness. It's the practice of understanding where your money comes from and intentionally directing where it goes. It is the bedrock of control. We explored debt and credit, the pillar of navigation. This is the knowledge required to strategically use the tools of our modern financial system without letting them control you. We moved to saving and investing, the pillar of building. This is the forward-looking part of your plan, where you build your safety net for today and plant the seeds for your future self through the power of compound growth. We learned about goal setting, the pillar of purpose. This is what transforms your financial actions from a series of disconnected tasks into a meaningful journey toward the life you want to live. And we covered risk management, the pillar of protection. This is the wisdom to protect everything you are working so hard to build from the unpredictable events of life. When you step back, you can see that these are not just separate topics. They are interconnected parts of a single, holistic system for managing your financial life. As you move forward from this series, you can distill all of these lessons down to a few core principles for lifelong financial wellness. The first is the principle of intention. This is the conscious decision to be the one in charge of your money. It's the shift from being a passive passenger in your financial life to being the active, engaged driver. The second is the principle of automation. We learned that you can design your financial life to make good habits the easy choice. By automating your savings transfers, your retirement contributions, and your bill payments, you put your financial plan on autopilot, ensuring that you are consistently working toward your goals without relying on sheer willpower. The third is the principle of patience. Financial success, whether it's getting out of debt or building a retirement nest egg, is a marathon, not a sprint. It is the result of thousands of small, consistent decisions made over many years. Embrace the long-term view and trust in the process. The fourth is the principle of continuous learning. The financial world is always changing. New tools will be invented and laws may be updated. This series is a foundational starting point, not an end point. Maintain a curious mind and continue to seek out knowledge from reputable, educational sources throughout your life. And finally, there is the principle of alignment. This may be the most important principle of all. The ultimate goal of financial literacy is to align your use of money with your personal values. Money is just a tool. It has no inherent value. Its only value comes from what it can do for you, your family, and your community. A well-crafted financial plan allows you to use that tool to build a life that is not just financially secure, but also deeply fulfilling. Financial wellness is a journey of continuous improvement, not a destination of perfection. There will be times you overspend. There will be financial decisions you look back on and wish you had handled differently. That is part of being human. The goal is not to be perfect, but to be aware, to learn from your mistakes, and to keep moving forward. By investing your time in this series, you have already taken the single most important step. You have chosen to be informed. You have chosen to be prepared. You have chosen to take control. That knowledge, once gained, can never be taken away. It is an asset that will pay dividends for the rest of your life, opening up a future of greater security, freedom, and confidence. Thank you for joining us on this journey. Continue to be curious, continue to learn, and continue to build the future you deserve.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.